Hey Scott, we've seen this over the past couple of weeks as far as people talking about SVB as a bank and a couple of other banks. And I just want to take some time and have you explain how does the banking system work and what are we kind of seeing with that right now?
Yeah, let's talk about it for a minute because there's been a lot of uncertainty in the market and a lot of volatility in the markets in general as a result of this. So let's just talk about how banks work so that everybody can understand how we got to this point. Basically, let's just pretend that you have $100 that you take into the bank and you deposit it in your checking or savings account.
Hmm.
Well, technically, the bank's required to keep a certain portion of that in liquid reserves. And it's not as simple as this, but let's just call it 10%. So the bank has to keep 10%. And then the other 90%, they can do what they want with it to try and create income. They're going to invest it in other ways. Now, of course, you as the depositor, they're going to pay you whatever percent you're going to earn an interest on your savings account. Let's just say it's a 0.5%. And so you're earning 0.5%. So they've got to earn at least a 0.5% on this money this other 90% that they get to invest somewhere to pay you whatever they're going to pay you, plus make profit for their bank. So usually what they'll do is they'll take that money and they'll lend it out to other members or people who bank with them in the form of car loans or personal loans or mortgage loans. And that's one way that they can create a spread and make some money on the money they're using. But if you think about it, if they give a car loan to somebody, they can't just suddenly call that car loan due because a car loan is typically a 5-year loan, let's say. And when they lend that money to someone, that person who's paying back that loan has a legal right to take the full 5 years if they want to. They're only legally bound to pay whatever that monthly payment is. So the bank cannot go to somebody and say, "Hey, we need cash because people are coming to our bank and demanding cash, so we need you to pay off your car loan." Because that guy's going to say, "Well, I don't have the money. I gave it to the dealer. They have the money, and I'll pay you what I agreed to pay you each month." And so that's where you get into an issue with people coming to a bank and saying, "Hey, I've got cash that I gave you and I want it back now," because the bank cannot easily just give them all their cash because it's tied up in all these loans that they've made. Now, in addition to loans, what happens is there's not usually enough demand for loans to use all of that money. So the bank will look to invest that money in other places like treasuries or mortgage-backed securities, other long-term investments that are really low risk that pay a decent rate of return. And in this particular case, with SVB, what happened is they invested, well, in a lot of banks. This is going on with a lot of different banks. But what they did was they invested a few years back into mortgage-backed securities and US treasuries that were paying anywhere from 2 to 2.5%. Now, normally that's a really good long-term investment because it's a 10-year guarantee that you're going to get 2.5% return on your money for the next 10 years. But what happened is the Fed then pushed interest rates up so high, so fast that now someone who's going to buy a treasury can get like a 6% rate of return if they buy a T-bill. And so, well, and maybe not quite that high, but you get the idea, right? There's this huge spread between what they bought at 2.5 and now someone else can get one at 6. If suddenly the bank has to liquidate their investments to pay cash back to depositors who are demanding it, they're in a bind because they've got this T-bill at 2.5% that nobody wants to buy because they can just go buy one at 6% and not even waste their time buying one. Why would you invest in something that guarantees you 2.5 when you could buy something that guarantees you 6? You're
You
not
must
even
be getting
interested.
a steep discount on it, right?
Yeah, that's exactly what it is. So then the guy who's holding the 2.5% bond says, "Well, the only way I can attract somebody to come and take my bond and not the 6% bond is to discount this asset substantially, and I'll have to take a huge haircut right off the bat and just say, well, I'll sell it to you at 80% of the face value. So they're taking these huge losses right up front just to be able to liquidate and get cash to give cash to borrowers, but they can't do that for very long because it chews up all of the strength of the bank, right? If you're selling your assets at a 20% discount, you're going to go under really fast. And so that's in essence what's happening. You can't go into a bank and have millions of people demand cash because they have to liquidate everything at a discount, lose millions of dollars, and those banks are going to go under in the process. So that's the mechanics of what's been happening.
Perfect. Well, and I guess the good thing is we're going to see some positive things come out of this in the long run. One of the ones I've been hearing quite a bit about is, I mean, currently FDIC insures about 250,000. That's likely to go up, from what I'm hearing in the next 3 to 6 months. Might go up to 500,000, might go up to 1 million, but that'd be a good thing. And then another part too is the banking, right? Like you said, for your example, that 10% of liquidity, that's probably going to get looked at and kind of restructured, I'd imagine. Maybe it's going to be 15% or 20%, or, they're going to kind of create a way for there to be more liquidity for banks. And so, while in the short term, there's probably a little bit of pain, in the long term, it's probably going to lead to a better overall system that functions at a much higher level. So,
Yeah, I would agree. And if anybody who's listening to this wants to have a conversation about how does this play into the mortgage side of things, how does this affect your ability to buy a home? Should it cause you to delay? Should it cause you to speed up? Those are all things that we can get together and talk about individually. So just reach out and give us a call, and we're happy to talk about how what's going on right now is going to play into the housing market.